Got to start with the autos and the auto parts. So much trade going back and forth between the U.S. and Mexico. What do you do with those auto stocks now?
Well, certainly right now it would seem a little bit late to sell them at this point. They've already taken a hit, and they have shown weakness on a number of lines. But we would have to think that this is likely leading to a crescendo in this tariff war. There's not a heck of a lot more that you can do. It's becoming, the administration is becoming a one-trick pony in terms of its approach to settling a trade dispute. It's by raising another tariff. The market doesn't like it. It's very clear that it's stating that. The amazing thing we have to say is that the market is as off as little as it has been since the first tweet on May 5th, as I recall. And the irony is, on April 30th, we were at record highs on the S&P 500. We've drifted, we're down about 6% from those highs at this point, and adding a greater percentage lower now. But we have to think that this ultimately is resolved. It's been pointed out not only on this desk, but by other commentators. This costs the American consumer. And there is an election coming around in 2020. This doesn't look like a great way to influence people and make friends.
So, Mike, as you think about the decline for May, in the context of the overall market, which is still up double digits for this year, how severe of a problem between what happened in China this week and what's happening in Mexico today do you think it is for the market?
It's starting to look like a little more of a breakdown with today's move down 6.5% in a month. What's interesting is, for as unexpected as today's measures were on Mexico, it just pushed the market in the same direction it was already trending, which is to assume challenges to growth for the second half of the year globally, to buy bonds and compress bond yields a lot, to essentially screen for the Fed to do something about this and ease policy, and to kind of create some kind of a valuation discount on cyclical stocks, which have been happening all month. So I wonder if we've already stretched far enough in this direction that a lot of that process has been underway. The problem is, once again, with this new policy, there's no process that we can kind of track and handicap on an ongoing basis. It's very discretionary. It seems very capricious in terms of how it's being initiated and applied. So the market just kind of wants to step back right now. And it really is creating a big gulf between stated Fed policy and what the bond market is now implying.
As we're talking, J.P. Morgan says it now sees the Fed cutting in September and December. They say if tariffs on Mexican goods do go to 25, the Fed, quote, may well need to cut by much more than 50 basis points. John? I mean, that's what the market, that's why we're not down more than from the...
We don't want to jump to conclusions right now. This is a day-by-day kind of thing, and we do know that a highly unconventional presidency can reverse positions pretty quickly. But we are headed right now right into the eye of the storm, at this point. And I've got to consider, the main thing I think is consider the secular trends that remain intact, the pain that is potentially inflicted on economies far and wide across the globe, and the likelihood that will lead to a resolution somewhere around the corner. And we think this is the crescendo. Remember, the darkest hour, usually before the dawn. I think we're far from the darkest hour now, and we may not have to get there.
It's going to get worse before it gets better.
Oh, David, the indignation that is felt by so many here within the marketplace, within the media, politically on this is well felt. The thing about it is we for 60 years, had a policy that essentially gave away our innovation, gave away our competitive edge for many of our corporations, and gave away our jobs. The administration is trying to reverse that from what we can see, but it appears to be in a highly heavy-handed in an unconventional manner.
That's specific to China, I would think. I mean, as you point out, what we're doing with Mexico is trying to deal with an immigration crisis through a tool that is not used in that way. What does this do to business confidence?
Well, we've got to say it certainly shakes business confidence to a significant degree, but we do think that business has become more accustomed to work within crisis since 2008. Getting through 2008 was an extraordinary event for everybody, including the Fed, business, the consumer, and workers. And it has created a different environment. We are more resilient. We may not be happy, but we're showing up for it.
This is the bull case among many. I mean, global fund managers are going to own some stocks, and if they own any at all, they're going to own ours.
Right. I mean, that's why the U.S. trades at such a premium. I would point out that emerging market stocks are up again today. for the third day in a row, while we've still been kind of trying to find a bottom.
Places like Vietnam benefit from all. You can't go to Mexico
Well, that's
now,
not too big in the
China.
index, but yes, it's true. The rest of the world also already felt its pain in terms of market declines before we did.
Michelle, the president has said repeatedly he wants the Federal Reserve to cut rates. Is he pushing them into doing that this year? Are you going to change your forecast?
So clearly the odds of a rate cut have increased, and just look at what the market is pricing in 75 basis points of cuts by the end of next year. I think it's really a function of how the trade war evolves now. If we get some near-term resolution, if there's a resolution at the G20, if markets then recover, I think the Fed can get away with not cutting interest rates, given what they're seeing from the domestic economy. The labor market's still strong. Initial jobless claims are still at very low levels. Core inflation with a temporary weakness in Q1, which was pretty painful. The data this morning showed some sequential growth in terms of cyclical inflation. So if we avoid a scenario where things escalate, I think the Fed is comfortable at hold, and that's the message they're sending. But the risks are clearly skewed that things are going to get worse. And if they do, the Fed might be left with no choice other than to cut interest rates to try to underpin the economy and prevent a worst-case scenario from evolving.